Can you take us through what you think about the trading week that we've had so far, and do you feel more bearish because of it?
Well, Dom, the Christmas song goes, the weather was frightful. And my goodness, here in Chicago, the weather is frightful. And the market, by and large, this week has been a whipsaw. Thin volume, expectations, and it's interesting to see. The market has really moved more towards an anticipatory market. So we do get better than expected data. Look at GDP just yesterday, and sure enough, we see a sell-off. So we are trusting and hoping that the Fed is going to continue to stay committed to what they say. But let's just rewind a year ago, Dom, when they talked about the transitory component of inflation. They were dead wrong. So I think the market has gotten ahead of itself. I look at the VIX. The VIX is elevated, but nonetheless, the VIX has been elevated all year. So I think where we are right now in the S&P 500, as we set up this very thin trading day going into the long holiday weekend, I think we're at the lower end of the range. But I do have some cautious optimism. I'm wearing the red coat, for crying out loud, Dom. I think there's a small sliver of hope for a Santa Claus rally.
All right, so Chris, we've been talking a lot about a Santa Claus rally because it is a seasonal tendency. It is not gospel by any measure, and we've seen a very dismal December so far. But when we refer to the Santa Claus rally, I know the technical people are going to say it is the final 5-day trading days of this year, the first 2 of the next year. But generally speaking, is the sentiment in your mind one that can turn around, or are we going to be like this in a downward churn for the first half of next year?
I mean, unfortunately, it's been a really negative year. The Santa Claus rally that a lot of people were expecting to happen still hasn't happened. And to your point, technically, there's still time for it to happen. But sentiment's very negative. It's been a difficult year. Unfortunately, there's not a lot of changes that are going to happen between now and the first quarter. So unfortunately, we're still feeling relatively negative, at least in the short run. For next year, there's probably 3 things we're looking for. We're expecting the unemployment rate to go up to 5%. We're expecting Fed funds to go over 5%. We're expecting S&P earnings to come down by 10% or more. So at least in the beginning part of the year, it does look a little bit negative. We think there's a lot of things you can do to protect your portfolio, whether it's putting in inflation hedges or going to some more defensive sectors like healthcare. But in general, we do think it's a negative setup, and we'll see what happens in the last week of the year. There's always that possibility if things go higher. I hope that we do get that Santa Claus rally. But if we do, it'll probably be pretty short-lived because, unfortunately, we're still in a bear market, and there's nothing that shows me that that's changed, at least at this point in time.
Chris Zaccarelli, bringing the coal for investor stockings right now. That doesn't sound good, but you did mention some of those defensive parts of the market, things that you like in healthcare. Can you take us through what's on the shopping list, hypothetically, for you, given that more dire outlook?
Yeah, absolutely. If you're looking more defensive, again, on the healthcare side, you could look at something like an Amgen, look at something like a Johnson & Johnson, those types of companies that should persist, whether or not we get a shallow recession or we somehow avoid it and get that soft landing that everyone's hoping for. On the other side, I think there's some energy names you can look at, whether that's Occidental Petroleum or Chevron. Both of those are great inflation hedges. So yes, typically if the economy does go down, energy suffers. This time may be a little bit different just because we're in an inflationary environment, and it does seem like, at least from an oil and natural gas production point of view, we're very undersupplied. So we may see a different tact in the energy sector this recession, if there is one, and that's one thing that I'd say is a little bit different than what we've seen the last 30 or 40 years.
All right, Jeff, what do you think? I mean, are you getting defensive? What's on your shopping list right now?
Well, Dom, we've transitioned from growth to value all year long. Yes, I do agree with Chris on owner energy. We want that theme, that sector to persist in 2023. We also like United Healthcare, Johnson & Johnson, that way to really protect the portfolio. But that industrial shift is appropriate. But where I'm going to push back on Chris is 2 of the things that he talked about. Earning expectations. We've already seen those prices come down. Valuations. But the one thing that's so underappreciated, it's this lag effect. I go back to all the years I traded U.S. Treasuries, and I look at the lag effect. So what happened? We saw the 10-year note pop from 1.5% to 4.5%. What happened a month or 2 or 3 later? We saw equities absolutely crater. To Chris's point, down 20%. It doesn't feel good. But where I do take a little bit of solace and where I think he is too defensive and too bearish is that the market has the ability to move higher now that we've seen the dollar cool off. Now that we've seen the VIX come down. But we've also seen U.S. Treasury stay tethered, specifically in the 10-year note, to 3.5%. So I think that puts us in a place where we've seen so much pessimism. We look at the 200-day moving average in the S&P 500, which is just about 200 handles higher here, about 40.23. If we do see a close back above there, and I know we've tested there a couple times, Dom, but that's going to catch a lot of people off sides. And remember, this is so critical to remember, volatility takes markets up in the same way it takes markets down.
So, Chris, that's an interesting point about what's happened with the dollar. It's not maybe surprising given the fact that the Fed has been arguably ahead of the curve with regard to raising rates and trying to fight inflation. So is that dollar story, the fact that it rose so much but is now not rolling over, but it's come off significantly in the last several months here, is that going to be a story for the early part of 2023?
It may be. And one thing I would say is while we're negative on the market in the short run, I agree. I mean, if earnings come down, but we're finding a bottom, the market can rally. So what the market does could be separate from what earnings do. And typically the market is forward looking. So I don't completely disagree with what Jeff's saying as far as the market going higher. But as far as the dollar story, for now, we've seen the dollar get a lot stronger, both because there's been a flight to safety, as well as the fact that the U.S. economy has been outperforming Europe, and China, for the most part, has been shut down. To the extent that we see the dollar get a little bit weaker, that is very helpful for the S&P 500. 60% of S&P 500 revenues are happening around the world, and so with the multinational index, the S&P 500 isn't as domestic as people think. So I agree. If the dollar does get weaker, that's helpful for the S&P 500. That'll make our goods much more competitive around the world. And that could be a bright spot for 2023 that some people are talking about, but I agree. It's worth highlighting. It's something that could be a big story for 2023, which would be
I'd like to jump in and say that could be a bright spot for the rest of 2022. The dollar index was up at 114. It's at 103 now. So what I'm trying to say is everything is reactionary or anticipatory towards the Fed. But what I think we see is a lag effect. So I do think we have a little bit of a move higher. We are going to test that 20-day moving average, and people are underinvested or they're caught off sides. That is the volatility that moves markets higher.